In this video, I'm going to show you how you can make $5,000 a month using one of my favorite option strategies for safe and consistent income. I will show you real trades that I took this week and share with you my exact thought process, the stocks I picked, and my reasoning for selecting the exact option contracts to sell put options. Let's go. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. Now, let's dive in and get started. A quick disclaimer before we get started. This video is for informational and educational purposes only. I am not a licensed financial advisor, and I am simply showing you my trades and how I trade. So with that said, let's understand what cash secured puts are and how the strategy works. A cash secured put is an option strategy where you sell a put option at a set price, also known as a strike price, for a set time. In return, you receive a premium for taking on this obligation. It is also known as a cash secured put because you need to have enough cash to cover the cost of buying the stock if assigned. Now, let's look at some of the benefits of cash secured puts. First, you will make money as long as the stock stays above the sold strike price at expiration. So let's assume Apple's currently trading at $100 and you sell a 90 strike price put option expiring for the following week. As long as Apple stays above the $90 strike price by expiration, you get to pocket that entire premium. If the stock price drops below the sold put strike price, which is $90, we will get assigned, and then in that case, we will go ahead and buy the Apple shares for $90. So technically, you're getting Apple at a discount of $10 from the time that you originally sold the put option when it was trading for $100. When we talk about risk, your risk is limited to having enough cash to buy the put options that you've sold at expiration. If Apple's stock price drops below $90, whether it drops to $85 or $80 or $88, you are on hook to buy Apple at the sold strike price that you sold your put options. So keep that in mind when selling put options and make sure that you are comfortable buying the stock at the sold strike price at the time that you're selling the put options. So moving along, some of the things that I look when selling put options are the following. Obviously, I want to make money, and that's the whole point of doing this strategy. So I look for stocks that offer good premiums. Again, my target is generally anywhere from 2 to 5% each month. So that's the range that I'm targeting when selling put options. Second, you want to choose a stock that has strong fundamentals and future growth potential. Because again, in case you are assigned, you want to choose a stock that is fundamentally strong and has high chances of coming back fairly quickly. Last but not least, you do not want to sell put options on meme stocks just because they offer higher premiums, because you know what's going to happen. It's going to eventually crash. And if it does crash while your position is open, you could be bag holding for a while. Next, let's quickly look at the steps that you need to follow to sell put options. So first, we just went over this, but you want to choose a stock that is fundamentally strong and has strong long-term potential. Next, you want to determine a strike price and expiration date when selecting the put options. I recommend choosing a delta of 15 to 20 when selling put options. And that simply means that there's a 15% or 20% chance of assignment at expiration. A lower delta will mean that you're safer, meaning that there's less chances of assignment. And a higher delta means that there are slightly higher chances of assignment, but a higher delta does offer better premiums, so the choice is yours. Obviously, you want to ensure that you have enough cash in case that you're assigned at expiration. And then you would just sell the put option, collect your premium, and monitor your position until expiration. So now that you understand how put selling works, let's look at my actual plays for the week. That's going to help you understand how you can make $5,000 a month selling put options. My first play for the week was on ACHR. And for those of you who are not familiar with ACHR, ACHR is Archer Aviation. Archer Aviation is in the business of making air taxis. Now, they're an early mover in this emerging industry. Their focus is on developing the Midnight eVTOL aircraft for urban air travel. Basically, it's air taxis starting with locations like the UAE and potentially expanding to US cities. They're partnering with United Airlines to explore New York air taxi routes. Also collaborated with Palantir on AI technologies for next-gen aviation. And they were recently named the official air taxi provider for the 2028 LA Olympics. Now, as you can see from the latest news, a White House executive order to speed up eVTOL integration positively impacted Archer's stock. This was just last week. And an analyst maintained a buy rating and raised Archer's price target to $18, citing confidence in the future. A leveraged ETF tracking Archer stock was also launched. Now, I do want to let everybody know that Archer is not profitable just yet, so this would be a slightly risky trade, but I'm comfortable with it, so I went ahead and sold puts on Archer. Now, I have Archer's 3-month chart pulled up here on Thinkorswim, and before I place any trade, my rule of thumb is looking at the 3-month or the 6-month chart and seeing where the stock's trading currently, and then making my decision as to what levels I'm comfortable selling put options. So I'm recording this on Wednesday, June 11th, and I placed my order on ACR yesterday, which was Tuesday. So looking at Tuesday's candle right here, the low of the day was about $11 and the high of the day was $11.50, so about a 50-cent range. And if I was just looking at yesterday's candle, I see some support right here. It's obviously close to the middle of the Bollinger Band. The exact middle of the Bollinger Band would be about 1085. And the next big level of support is the bottom of the Bollinger Band, which is about $9. So as you can see, there's quite a lot of gap between the middle and the bottom of the Bollinger Band. And looking at some support in between the middle and the bottom of the Bollinger Band, I see some support right here, which is the bottom of this red candle at the 1022 level. It's also the top of this next candle right here, which is again about the 1020 level. So next we're going to go to the options chain and I'm going to show you which options contract I chose to sell put options on. So we're going to go to trade options chain and we're going to go to the June 13th options chain. And as you can see with this red triangle right here, I went with the 1050 options. Now, obviously, Archer is trading quite higher compared to yesterday. It's about 70 cents or 75 cents higher than what it was yesterday, which is great because as a put seller, you want the price of the stock to rise. And that just means that your put option will become profitable faster. In fact, once your put option reaches a profit of 50% or higher, if you like, you can even buy back the put option and exit the trade earlier and then re-enter or sell another put option. So as you can see, the 10.5 strike price right now it's actually a delta of 5, but at the time when I sold it yesterday, it was close to a delta of 20. So obviously with the higher delta at that time, because the stock was lower, the premium that I was offered was 13 cents. And I went ahead and sold 10 contracts. So that would be 13 cents or $13 per options contract times 10. And that's basically $130 that I collected selling 10 contracts on ACHR at a strike price of 10.5. And all this means is that come this Friday, June 13th, as long as ACHR stays above 10.5, I get to keep that entire premium and I can place a trade on it again for next week. Now, if ACHR falls below 10.5, I will be assigned unless I roll, which is a different topic. And I actually have another video on rolling. But if ACHR drops below 10.5, I'm on the hook to buy 10 contracts, which is 10 times 100. That would be the amount of shares that I would have to buy at a strike price of 10.5, no matter the price that ACHR is trading at on Friday end of day. My next play was on HIMS. And again, for those who are not familiar with HIMS and HERS, it's a telehealth platform offering personalized health and wellness services, including access to medications, skincare, and weight loss programs. I have the 3-month chart pulled up for HIMS, and I took this trade yesterday on Tuesday, June 10th. So looking at this red candle right here, it briefly touched the top at 58.36, and then the bottom was 53.95. And it ended the day around $54. So given that HIMS is trading close to the middle of the Bollinger Band, the next obvious level of support is actually the bottom of the Bollinger Band, which is about the $50 level. So let's look at the options chain and see which options contract I selected. So we're going to go to the June 13th options chain. And if you can see, I actually went with the 52 strike price. Now, I know it's a bit higher than the bottom of the Bollinger Band, but I did want to collect good premiums on this trade, and I was comfortable picking up HIMS at a strike price of 52. So again, guys, the delta is important, but what's more important for me when I place these put option trades is actually acknowledging what price I'm comfortable picking up the stock. So a lot of times when I sell these put options, I sell low deltas like 10 or 11 deltas, or in other cases, I'm comfortable placing trades on put options that are slightly higher than 20. So depending on the stock and what level you're comfortable buying the stock or being assigned, that's the level that I would pick. I went ahead with this 52 strike price. And as you can see right now, the stock has risen quite a lot from the 54 to the $57 level. So this delta, which is 9 right now, was close to maybe a 13 or 15 delta yesterday. Right now, this options contract is offering us only 19 cents. Even if I look at the mid price between the bid and the ask, that would be about 20 cents. But yesterday, when I sold these put options, I collected 48 cents per options contract. So 48 cents is $48 times 4 contracts is what I sold. And I collected $192 by selling 4 contracts on HIMS. My next play was on Robinhood, and I have Robinhood's 3-month chart pulled up. I took this trade last Friday, June the 6th. And as you all may recall, there was a lot of buzz around Robinhood being inducted in the S&P 500 around that time. So the premiums were elevated, and I wanted to take advantage of that opportunity. So if you look at the candle right here, it was trading around the 73 level on June 6th. And obviously, it's still in that range, in the $73 to $75 range. And given that it's closer to the top of the Bollinger Band, I wanted to ideally shoot for the middle of the Bollinger Band in case there was a pullback, and then that would be the level that I'd be comfortable picking up Robinhood. So as you can see very clearly, the middle of the Bollinger Band is a strike price of 67.11. So looking at the options chain, and we have the June 13th options chain pulled up for this Friday. As you can see with this red triangle right here, this is the options contract that I went with. And as we all heard on Monday that Robinhood was not in fact inducted in the S&P 500 this time around. And because of that, we pretty much had an IV crush where the implied volatility of Robinhood dropped from what it was on Friday coming on Monday. So the options contract at the time offered me 90 cents on $90 per options contract. And right now it's only 8 cents at the moment. So if I wanted, I could just exit the position. But because I like Robinhood, I'm okay waiting out until Friday. And in case there is a drop in the Robinhood price, I'd be happy to pick up some shares at a strike price of $67. Let's do some math here and see how much premium we picked up by selling 4 contracts at $90. So that would be $360 is what I picked up by selling 4 option contracts on Robinhood expiring this Friday. My next play was on Nvidia, and Nvidia has also been trading in this tight range here in the 140 to the 145 level. So I took this trade yesterday, and looking at Nvidia's current positioning, it's closer to the top of the Bollinger Band. And the next obvious level of support is the middle of the Bollinger Band, which is 137.37. So I went to the options chain and I sold the 137 puts expiring for this Friday, June 13th. And right now, this options contract is offering us 25 cents. But at the time that I sold it yesterday, I collected $58 per options contract, which gave me a premium of 58 times 4 options contract. So I collected $232 selling 4 options contracts on Nvidia. For my next play, I went with another one of my favorite stocks, which is Palantir Technologies. I took this trade yesterday on Tuesday, June 10th. And looking at yesterday's candle, it ranged from the 129 on the low end to the high being close to 134 or 133.57. And again, Palantir is trading in between the top and the middle of the Bollinger Band. Well, actually, today is at the top of the Bollinger Band, but yesterday was close or getting closer to the top of the Bollinger Band. So looking at the middle of the Bollinger Band, that's a strike price of 128. And the bottom of the Bollinger Band is a strike of 118. We have some support in between the two lines at a strike price of 120. So let's go over to the options chain and see which contract I picked up. I have the June 13th options chain pulled up. And as you can see with this red triangle right here, I went with the 123 strike price. Palantir was trading close to the 133 strike price. And knowing how volatile Palantir can be, I was comfortable selling the 123 puts, and I collected a premium of $52 per options contract. In this case, I sold 2 put options, collecting a premium of $104 on Palantir. My final play for this week was on none other than SOFI Technologies, another one of my favorite stocks. And looking at SOFI's 3-month chart right here, I took this trade on Monday, June 9th. And as you can see from this red candle right here on Monday, the top of the candle was 14.34 and the bottom was close to $14. So looking at SoFi's position on Monday, again, close to the top of the Bollinger Band. So the obvious next level of support for me is the middle of the Bollinger Band, which is about this 1350 strike price level. And then the bottom of the Bollinger Band would be 1263. Let's pull up the SoFi options chain and see which contract I went with. So as you can see from this red triangle right here, I went with the 13.5 strike price, which was the middle of the Bollinger Band. And right now it's only offering us 2 cents because obviously it's the middle of the week. And SoFi actually has risen up to $15.11. Actually, it closed at 15.11 this afternoon on Wednesday, June 11th. So at the time, I collected 12 cents per options contract and I sold 10 contracts collecting $120 for this Friday. If SoFi were to drop to 12.5 by this Friday, I'd be happy to pick up 10 contracts, or basically 10 times 100 would be 1,000 shares at a strike price of 12.5. So let's look at a summary of all the trades now and see how much premium we collected by selling put options on all of these stocks. So as you can see right here, these are all my open positions at the moment. We're starting with ACR at the top. And if you see this column right here, cost in parentheses is what I collected as a premium for this options contract. So I'm just going to go to Google and we have $130 on ACR. So we're just going to do 130 plus for the next one, we have $192 on HIMS. And next up, we have $360 on Robinhood. And for the next trade on NVIDIA, we collected $232. So that's 232. And on Palantir, we collected $104. And for our final trade on SoFi, we collected $120. So that's a total of $1,138. Now I had one other trade on Robinhood for another $100. So I'm going to go ahead and add that here. And that brings my total to $1,238 selling put options on all of these stocks for 1 week. So we do this times 4 weeks to see how much it would add up being for the whole month. And if I did this 4 times in a month, which is obviously 4 weeks, that would get us to our target of $5,000 a month. So that's it for this video. I hope you found it helpful and educational. If you enjoyed this video and learned anything useful, please give it a thumbs up, subscribe to my channel, and leave your comments below with any thoughts or feedback. If you'd like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out. See you in the next one.